But crypto is like traditional markets and traditional market psychology, except on steroids. And so we might be dealing with a market that is like 99% scam, 99% going to zero. And then people will see that and they'll dismiss the entire thing. Crypto is not anything special. And so some of the lessons that we can learn that you've brought out in your book about kind of traditional financial markets investing, they apply 100% to crypto, and maybe even more so because crypto is just traditional markets on steroids. I think that's a crucial piece of the puzzle that crypto investors could stand to learn. So the first thing I want crypto listeners to hear is that, hey, Morgan is saying and Ryan is saying crypto is not special. Okay, it just falls into the patterns of every other market that's always been here. I think for investors to just hammer in their head in general. And that's the thesis, I think, of your book, that, hey, good investing is just good psychology. And people have to level up. I mean, we're always obsessed with kind of the external skills or more information that we can kind of bring to the system, when the real battle or journey in an investor's life is kind of an internal journey.
I think that market participants are finally coming to terms with this, right? And one of the things to remember, though, is that markets are forward-looking. So we could have a scenario where the market goes down. Now that inflation is remaining sticky, this is new information, right? It's new information to a lot of people that, wait a second, core inflation is up. Like core inflation is up 5.9 to 6.3%.
I knew we were getting higher inflation. I knew we were getting weaker growth, but most people didn't know that. But what's still happening is every time investors are surprised with a hotter than expected inflation number, that makes them feel that the Fed is now going to have to fight harder to bring inflation back down to 2%. Nobody doubts the Fed's resolve or its ability to bring inflation back down to 2%. So the higher inflation goes, the harder everybody expects the Fed to fight to win, and that keeps propping up the dollar, and that keeps suppressing gold. I always talk about the Grayscale Bitcoin Trust when I talk about ARK. They're very highly correlated, being highly speculative. That trust was down 10.9% on the week. In fact, it closed the week at about a 34% discount to its net asset value. That's about as big a discount as it's had. And I think technically that fund is looking horrible going into next week. And we might see a major blowout in the discount to NAV. And that could portend a much bigger drop in Bitcoin itself.
What I see is Bitcoin becoming more like gold and long bonds in an extended deflationary recession. And I think that flipping is way too ahead of itself, because I see risk assets having a problem for a long time. I think Bitcoin's going to migrate towards long bonds and gold in a deflationary, elongated recession. I think Bitcoin will come out ahead. So I think it's a while for that. But it is a trend. I mean, Ethereum has been, moving forward with Bitcoin forward, but right now I think it's just a little bit expensive versus Bitcoin because of all the hype around the merge. And it's probably going to come back for a while relative to Bitcoin.
The big thing to recognize on Bitcoin here is that you basically have been hovering just above or just below the 2017 high. So I'm going to bring up a trend line here, and we're going to go all the way back to those 2017 highs and put in this line here. And you can see that the market has just been hammering on this over and over again since June, so many times. Now the kicker is, and you can see Bitcoin's actually come back amazingly well today, but what we saw yesterday was a close below. And what you look for here is a secondary close below the low of the first candle that closed below. And I know that sounds complex, but basically what needs to happen here is you're looking to see, does Bitcoin today close below the low of yesterday?
Gold and Bitcoin. And there's nothing wrong with cash. There's a good thing about, and that's the key thing I think the history books are going to say is, remember that thing called Tina? What it did is just push people into risky assets. Cash can be okay when everything else the tide is ebbing and you're not going down. So I wanted to bring gold in today. The fact that gold's down 2% on kind of a meh day is indicative to me of people just hitting their stops. Just get me out. And I think, gold should come out ahead, but this happened in 2008. I think this is the big one where, I'll give you an example. 1929, the stock market went down 50%. Then it rallied 50% up to 1930, and then everything went bad. And unfortunately, for the Fed to stop this sledgehammer, risk assets have to make them stop by tightening for them.
when people spend money, they're spending more money to buy stuff, but they're buying less stuff. They're paying more, but they're buying less. And if they're buying less, then the volume goes down. I expected all along the U.S. stock market to roll over and ultimately make new lows. And the reason I knew it was going to go down wasn't just that I knew the market was overvalued, which it was, but I knew that inflation was going to keep surprising to the upside.
Look at FTX, built during the previous bear market. Look at Solana, built during the previous bear market. Look at Luna, even though it collapsed, built during the previous bear market. Look at Arweave, built during the previous bear market. Bear markets are the time for building, and bull markets are the time for hype and distractions. The NASDAQ at the bottom of the bear market is 21.36% higher than the pre-COVID high. Okay, that means that if you would have invested in the NASDAQ, you would have made about 11% a year. That's not a bad return. That's not a max pain return. If you take it from the bottom of the COVID cycle, the NASDAQ is still up 80%. Okay. At the same time, as I said to you, interest rates haven't even started climbing, and nothing that the Fed has done up until now has worked to reduce inflation. If you look at the progress that this protocol is making, I cannot find any blockchain that's building as fast and so many things on Kujira. In fact, they announced, I think today, they announced they're going to be having perpetual swaps coming to their blockchain.
I think the same thing with ETFs. I mean, there's a reason why we haven't seen the approval of a Bitcoin ETF yet. It's because the SEC hasn't approved it based on the fact that there's too many gray areas for these cryptocurrencies. So look for that to happen as well. I mean, I think this is the kind of the exciting thing for me with crypto is that once we get the regulation, I think the dominoes start to fall, and you actually could get a significant bottom in, at that point in cryptocurrency when you have this kind of clarity. The only thing I would be a little cautious about is that how many of these altcoins were moving in tandem with Ethereum over the last 90 days going into the merge, right? So the question is, if Ethereum starts to kind of wind down and continue down, do these start to underperform, and maybe the other coins like Bitcoin start to outperform and kind of readjust? Right. So that would be my only concern, I think, with that performance. I wouldn't necessarily jump to that conclusion of, it's a new altcoin season type thing.
You can see how well it lines up. Ethereum, by the way, and I was talking about this on one of the premium videos, is if you look at Ether, I mean, it looks like it has a lot further to fall, honestly, than Bitcoin, if it's going to play out like it did last bear market, because there's a lot of divergence in this move, and arguably it's because of the merge. The idea of a recession, that kind of stuff, certainly makes sense for people to continue to remain cautious. I've told you guys since the beginning of the year that cash is king. The idea of a recession, that kind of stuff, certainly makes sense for people to continue to remain cautious. I've told you guys since the beginning of the year that cash is king. If Bitcoin USD bottoms at whatever level it bottoms, for the most part, most altcoins that are at least going to stick around for the following cycle tend to bottom against the US dollar as well. But I wouldn't necessarily say they can't continue to bleed against Bitcoin for at least a few months before really finalizing a new uptrend in the Bitcoin valuation. I think a lot of people have heard my general thoughts on the altcoin market this year. Markets are risk off. I mean, for innovation ETFs, that kind of stuff, these risk assets, really high risk assets, that's not going to do well during high interest rates, or at least not necessarily during high interest rates, but during a period where the Fed is aggressively hiking into a slowing economy. So yeah, if I were them, I can understand why they would put that out. That doesn't mean the Fed is going to care or do anything about it, because the Fed is not here to sort of prop up Tesla's valuation. They're not here to prop up the ARK fund valuations. They're here to make sure that inflation stays under control and that unemployment stays low.
And I think last time I was on it, we talked a little bit about the potential that we could actually see the market go sideways for 10 years, much like the .com collapse did until the NASDAQ took out its highs. And I think that's important to think about, because if you look at how has the market gotten out of every big drop in the last 10, 12, 15 years, right, and the answer is the Fed has printed us out. Well, now you take a situation where inflation, let's say, is at 4% or 5% in the next year. How does the Fed print us out of that? And I think I'd liken people to take a look at the Hang Seng chart, the Brazilian stock market chart. They had these massive runs around 2006, 2007, and those charts have gone sideways since then, and they have never taken out those highs. And I think that could be what we're looking at, mainly because, again, the Fed, by printing so much money, pulled forward a lot of that upside growth, and now we have to kind of pay for it by this longer consolidation digestion.
We don't think we're in an 18 multiple. We think the multiple as you go forward over the next 12 months is much lower than that. So I mean, much higher than that because our earnings are going to be down. But eventually, the prices will go down far enough to where you can make it work. We just don't think you can make it work right now. When unemployment starts rising, you get into that's when you're in a real recession. And so we haven't gotten that yet. Just barely touched it, but it's once that starts and gets deeper, then you're in a real recession, and then you're in a situation where companies are going to really have to adjust out earnings. The Fed did such a disservice during that 10 or 12 year period to everyone, really, by keeping those rates there. And obviously, again, a totally irresponsible Fed and fiscal government too, if you want to get right down to it. If you take the effective Fed funds rate, it's probably around 230 or 240. The stated rate would be 250, and they're going to probably raise it. Let's say they raise it 3/4 this month to 3 1/4. There has to be a point to where your Fed funds rate and your inflation rate are fairly close. The problem about last year was they were so expensive, Jack, that it didn't make any difference what the interest rates were. Everything was so expensive, and even if you calculated a high earning rate for the next 5 years, you still couldn't make it work. And that's what we got into last year. Nobody could see it. I mean, they were all sort of drunk on the numbers, but that's where we were last year.